Imagine investing in one of the fastest growing companies in the UK, and a few years later, your investment is basically worthless, while the founders and private equity walk away with hundreds of millions of dollars. That's exactly what happened with BrewDog. Over 200,000 people invested £75 million in one of the biggest crowdfunding campaigns in the UK. This was a company with a cult-like following. We're talking people tattooing the brand to their body to get a free beer. So how does a company like that scam its own investors? BrewDog started in 2007 in a small town in Scotland by two guys in their early 20s, James Watt and Martin Dickey. They were fed up with how boring beer had become in the UK. At the time, most of it was the same. Light lagers, mass-produced, nothing bold, and mostly dominated by the same big companies like Heineken and Carlsberg. And they weren't just trying to start a company, they had a mission. They wanted to kickstart a craft beer revolution. Watt handled the business side like sales and marketing, and Dickey was the brewer. They started bottling beer themselves and selling it at local farmers markets. But what they were making was different. Stronger flavors, bolder branding, inspired by American craft beer that just wasn't common in the UK at that time. And people loved it. Within a year, they were already scaling up production and growing fast. Then in 2008, they won the Tesco beer competition, taking first, second, third, and fourth place. They completely dominated it. And that's when BrewDog really took off. They went from selling locally to being stocked in over 500 Tesco stores across the UK. But it wasn't just the beer people were drawn to, it was how they marketed it. BrewDog leaned hard into this anti-corporate, rebellious identity, openly going after big beer companies and everything that they stood for. And they were not quiet about it. They pulled crazy stunts like sending a coffin filled with mass-produced lager to big beer companies to show that corporate lagers are dead, or brewing a 32% alcohol beer just to prove a point. They were loud, they were controversial, and it worked. It didn't feel like just another brand anymore, and people really bought into that, and BrewDog knew that. And as the company started growing fast, opening new locations and expanding internationally, they needed more capital to scale. But instead of going down the traditional route and raising money from venture capital, they did something different. They went to their own customers. In 2009, BrewDog launched Equity for Punks, a crowdfunding campaign where anyone could invest and own a piece of the company. And people loved it because it didn't feel like a typical investment. It felt like becoming part of something they already believed in. You weren't just putting money into a business, you were backing a movement. BrewDog leaned hard into that. And it marketed itself as a rebellion. Join the mission, own a piece of the revolution kind of thing. And on top of that, you got perks. Discounts on beer, exclusive events, early access to releases, even things like free drinks on your birthday. Basically, the more you invested, the more you got. So for a lot of people, it didn't even feel like a risky decision. It felt like something that they were already part of, just taken one step further. And the numbers showed it. Over 200,000 people invested £75 million across multiple rounds. Some people were putting in a few £100s, others were putting in thousands. But almost all of them believed the same thing, that this was going to be big and they were getting in early. And then things started to change. In 2017, BrewDog brought in private equity firm TSG Consumer Partners. They bought roughly 22% of the company for around £230 million, valuing BrewDog at over $1 billion. The founders cashed out a big chunk, taking around £100 million each off the table. On the surface, it looked great. More capital, faster expansion, global growth. The whole thing was pitched as rocket fuel. More bars, more countries, bigger scale. And most people liked that, but the deal came with a catch. TSG didn't get the same shares as everyone else. They got preferred shares, which basically meant they got paid first. Before the founders, before the company, and definitely before the 200,000 investors holding ordinary A and B shares. And on top of that, their money was compounding at around 18% a year. So every year that passed, the amount BrewDog owed them kept growing, hundreds of millions over time. At the time though, most people didn't question it, because everything looked like it was working. BrewDog expanded aggressively, new bars opened across the UK, the US, and Australia. They had breweries in Ohio and Atlanta, and at one point they had over 100 locations globally. From the outside, it looked perfect. But behind the scenes, things weren't as strong as they looked. The expansion was expensive and the company wasn't profitable. Year after year, losses started piling up. $30 million one year, $50 million the next, and it just kept going. And now they had a real problem. A company that wasn't making consistent profits, sitting on a lot of debt, and an investor at the top who had to be paid first. You could start to see the cracks. Bars that had opened just a year or two earlier were already shutting down, staff were being laid off, the company that once felt like it couldn't stop growing was now quietly shrinking. For the everyday investors, the ones holding ordinary shares, the reality was starting to set in. They couldn't sell their shares. I mean, there was no real market for them, and the valuations BrewDog was showing in those crowdfunding rounds, they were starting to look disconnected from what was actually happening. Some people started doing the math. They realized that for their shares to be worth anything, BrewDog would need to sell for well above what was actually worth at that point. Because no matter what BrewDog sold for, TSG was first in line. And after years of the deal compounding, the line was very, very long. And that's exactly what happened. In 2026, BrewDog's UK business collapsed into administration. Most of its UK and Irish assets, including the brand, brewery, and major operations, were sold off to Tilray for around £33 million, a fraction of what people expected from a company once valued at over $1 billion. When the money was finally distributed, it followed the structure that had been set years earlier. TSG got paid first. They likely walked away with anywhere between 600 million to over 200 million pounds in net profit. The founders already took their money years before, and by the time it reached everyone else, there was nothing left. Over 200,000 everyday investors, people who put in their own money believing in the brand, walked away with zero. Look, I'm not saying crowdfunding is a scam or that investing in startups is always a bad idea, but the story shows something most people don't think about until it's too late. When you invest in a company, the type of shares you hold matters just as much as the company itself. It doesn't matter how fast it's growing, what the numbers look like, or how much you believe in the brand. If someone else gets paid first, you're not playing the same game. The private equity firm had lawyers, structured deals, and built-in protections. The everyday investor had a logo and discount on beer. And yeah, they did own shares, but ownership without protection, without liquidity, or without priority isn't the same as being on equal footing. The brand was real, the community was definitely real, but the structure, that was never the same game. If you found this useful and want more breakdowns like this, subscribe and I'll see you on the next one.